Hello and welcome to the webinar on S&P BSE Sensex Index Fund NFO, brought to you by Axis Mutual Fund. My name is Saurabh Pandey and I will be your host today for today's webinar. We will discuss the feature and benefits of this new fund offer, which is an open-ended index fund tracking S&P BSE Sensex TRI. The scheme provides diversification as the S&P BSE Sensex Index consists of 30 companies spread across 14 industries. To explain more about the scheme, we have with us Bableen Kaur, who is the Senior Product Manager with Axis Mutual Fund. She has more than 11 years of experience and has been instrumental in designing and launching various innovative products in Axis Mutual Fund. And before we begin, let me remind you that this webinar is for informational and educational purpose only. Investors are advised to consult their financial advisor before making any financial decision. So now, without further ado, let me invite Bableen Kaur to take over the webinar. Over to you, Bableen.
Thanks, Saurabh. So good evening, everyone. So in the next couple of minutes, I'll take you through the basics of passive investing and also take you through more details about the NFO that we have come out with. So the NFO started yesterday and will continue till 22nd February. Now let's start with the presentation. So starting with the basics of passive investing, what is passive investing? So primarily, it's a predefined benchmark that we will be using, right, in a passive investing, and a portfolio replicates that benchmark, right? So we have a predefined benchmark and a portfolio which tries to replicate that benchmark. So the in benchmark constituents are replicated. The proportion in which those constituents are present in the benchmark, even that is replicated. So by doing this, what we are doing, we are relying on the broader market wisdom and removing any kind of risk of security selection. Now, since it's a passive strategy, right? So we're not, kind of actively buying, selling the securities. It's a low-cost strategy. So if you are an investor, looking for low-cost investment solutions, you can consider passive funds. Now, there are two types of passive strategies, passive products, which are available in the market. These are ETFs and index funds. Now, passive as a category is very big globally. If you would have, heard sometime back in news, we read that, in US, the AUM of passive funds had surpassed the AUM of active funds. So in India, we're not there yet, but the popularity is increasing at a very rapid pace. In the last 7 years, the AUM of passive strategies has increased by more than 10 times. And currently it's more than, so ETFs and index funds put together, the AUM is more than 8.5 lakh crores. So now, as I mentioned, there are two kind of avenues through which, you can, two kind of avenues for passive investment. So one is ETFs and second is the index funds. So in case of ETFs, what happens is that it trades just like a stock on an exchange. You can buy and sell on real-time prices. So for that, you need to have a demat account, and the costs associated would be the TER and the regular trading costs. While in case of index funds, the second format through which you can invest in the passive strategies, you make purchases and redemptions just like a normal mutual fund at the closing NAV of the day. If you invest before the cutoff or you redeem before the cutoff, you get the same day NAV, just like any other normal mutual fund. Now here, the expense associated with it is the TER. And in case of index funds, you can participate in them in a disciplined manner through systematic investment plans, systematic transfer plans, and even SWP facilities are available in the index funds. So these are the two types of passive strategies that we have. Now to summarize, why should one invest in an index fund? So firstly, so these are the low-cost investment options through which we are trying to participate in the markets, and our endeavor here as an investor, your objective is to seek market-linked returns. We are not talking about any kind of alpha generation, so we are talking about market-linked returns. Now, an index basically follows a certain methodology. So, and the constituents which make the mark basis that methodology are a part of the index. So your investment style in this case is consistent. and there is no fund manager kind of bias in case of security selection. So these are not actively managed portfolios, and if you want to avoid any sort of uncertainty on the potential alpha creation, on the potential outperformance from the market, so these are the low cost strategies which you can look at. Now, getting to the fund, so the NFO Axis S&P BSE Sensex Index Fund. So, starting with a broader macro overview. So, India is one of the largest economies. One of the fastest growing amongst the major economies. If you look at the IMF forecast for 2024, IMF has projected that we'll grow at 6.2%. Now we have and we have a multi-year growth visibility in front of us, because capex cycle is seeing we are seeing signs of revival in the capex cycle. So since the last couple of years, government had been doing a lot of heavy lifting in terms of capex, but now the other two components of the private capex, which is housing and the private sector capex, are also seeing turnaround. So since the end of 2020, after 7 years of consolidation, we saw an uptick in the housing cycle. We saw a huge pent-up demand. The volumes have tripled in the last 3 years, and we are in the mid-cycle affordability. So that is one segment which has turned around. And if we talk about the corporate capex here, corporate balance sheets today are very robust. Capacity utilization is at more than the average levels. And the environment is conducive, and if you look at signals like new orders in that sense, and new project announcements, they are pointing to the fact that it's a revival we are seeing in that space. So even our banking system today is well equipped, is well capitalized, has a good asset quality, so they are well equipped to support this capex cycle revival. So broadly, to summarize, this means that we have multi-year growth visibility in front of us, and to participate in this, equities is a very good means. And if you look at the market capitalization in terms of the global market capitalization, we are the 5th largest in the world. So our market cap recently touched $4 trillion US. So we have come a long way. To give you a perspective, 10 years ago, none of the Indian companies featured in the top 100 global companies list. But today there are 3 companies which are there in the list. But having said that, we have a long way to go, right? So Indian companies today are still very small. Indian large caps, for example, if I talk, are very small compared to the global large caps. So there are a lot of compounding possibilities even in the large caps today. So now coming to the index, what is the S&P BSE Sensex index? So this is the oldest stock index in the country, which has a track record of 38 years. So it's a well-diversified index. It has 30 stocks, which are the largest companies, liquid, financially sound. So these are blue chip companies, which are leaders in their respective segments. So these 30 stocks represent more than 40% of the market cap of the Indian markets. Now, if you look at the constituents, so very well diversified index. So other than the top 5 constituents, for other constituents, if you look at it, each constituent is less than 5% of the index and represents various sectors. Now, as I mentioned earlier, index methodology is defined. So the underlying stocks can change depending on what fits into that criteria. So the 30 stocks that you're seeing today may not be the same 5 years from now, right? 30 stocks that you're seeing here today may not be the same 10 years from now. And likewise, it was the case, historically, the constituents of the Sensex have changed. If you look at the sectoral diversification, it's a well-diversified index. The largest weight here we have is of financials, followed by IT, oil and gas. So it basically represents the 14 key sectors of the Indian economy. So these are sectors which are key from a current perspective, right? As I mentioned earlier, there may be some changes in the index. So if you look at it in 2000, the weight of financials in the index was around 10%. Now today it's around 40%. So it gives a clear representation of what is happening, clear representation of the sectors which are key in the current context. And this is very well diversified. If you look at it, you are having an exposure to 14 sectors. So if you look at the wealth creation journey, so since inception, Sensex has generated CAGR returns of close to 13-14%. Right. So despite the various market up cycles, up and down, the returns have been pretty good on a CAGR basis. So the key here is that one should stay invested for a long term, irrespective of the near-term volatility. What it does in the sense is that it improves your investment experience. That is the key here. And now if you look at the calendar year returns for the Sensex, so out of the last 20 years and 17 years, it has generated positive returns. And if you look at, the latest 2023, it has generated around 19% returns. Now, when we look at a large cap segment, an index like Sensex, which has 30 largest companies in the country, well-established companies which are financially sound, have established business models. So these companies have a lower volatility when we compare it to the other market segments like mid and small cap. Right. For example, in this chart, you can see that if you look at the standard deviation of returns, in case of Sensex, it is almost half of mid cap and small cap index. So, while equity markets are non-linear in nature and there is an inherent volatility, but in this segment, when we talk about the Sensex, you will have a lower volatility compared to a mid and small cap, because these companies, as I mentioned, are well-established and top companies, leaders in their respective fields. And also, if you look at the numbers on a 10-year basis, if you look at the 3-year rolling returns, so there are very small instances where you will get a negative, where you would have got negative returns in case of Sensex, while case of mid cap and small cap, it's a very reasonable number. Now coming to valuations. So the valuations, in terms of valuations, today we are trading slightly above the historical averages, right? In that sense, what is important is that there are a lot of factors supporting, a lot of factors working in favor of the markets today. Our domestic macros continue to be stable and strong. And the domestic flows today are very strong. If you look at the corporate earnings, they are also pretty robust. And we're also anticipating a stable political environment. So all in all, a lot of factors are in the favor. And if we are talking about participation in the growth story here, one should stay invested for a long-term perspective. In the near term, so there are a lot of uncertainties, some uncertainties on the global front in terms of growth, in terms of inflation, any sort of geopolitical uncertainty. So these factors may cause some sort of volatility. But as an investor, if you want to participate in the growth story we are talking about, one should stay invested for a long term. This enables you to capture the best days of the market, right? So equity returns are non-linear. So you cannot be, you should recognize that and stay invested for a long term to take advantage of that, best days in the market that we have. Now to summarize, so Axis S&P BSE Sensex Index Fund. So basically, we are trying to replicate the Sensex Index, which has 30 stocks, which are the largest, the leaders in their field, well diversified across 14 industries, and they are a representation of the current economy. And it's a market. The product will give you kind of market-linked returns, where we're not trying to generate any sort of outperformance, but we are trying to go with the market, with the broader market wisdom, and it will have a lower expense structure because it's a passive strategy. And also, as an investor, You can look to invest in a disciplined manner. You can offer SIP and invest in a regular manner in the markets. And the key here, again, I would like to reiterate, is to stay invested for the long term. One, it would improve your investment experience. And secondly, you will be able to reap the benefits of power of compounding. Now, some facts about the fund. Exit load for the fund is nil, and minimum investment amount here is 500. And the fund managers are Karthik Kumar and Ashish Naik. So that is from my side. Now, if you have any questions, we can take it.
Thank you, Bubbly. That was indeed a very wonderful session. And we do have a lot of questions coming up. And I can see, okay, Akhil from Hyderabad is asking, what is the time horizon for the investment?
Yeah. So time horizon minimum, I would say that one should look at a 3-year kind of an investment horizon. But the longer your investment horizon is, the better it is. For example, if someone is invested for 5 years and someone is invested for 3 years, so over a 5-year period, the probability of any sort of negative surprises that you would get in the market are reduced, because you smoothen out the impact of any kind of volatility in the markets. So minimum 3 years, and it's better to go, long term, even longer, so the better it is.
Okay, perfect, perfect. And we have one more question coming up from Priyanshu. Is it a good time to invest in the index fund as they are trading near all-time high?
Okay. So talking specifically about the Sensex index, since we're talking about this scheme, so valuations, they're slightly above the long-term averages if you look at it. But if you look at the other segments of the market, mid and small caps, they have run up quite a bit. So in that sense, today amongst the market segments, this is a segment which is more relatively better placed in terms of valuations, right? And as I covered in my presentation, there are a lot of factors today supporting the market, right? If you want to participate in that growth story, the capex story, the earnings being robust, and the flows, domestic flows are very strong, and even there is an expectation that FII flows would be as the interest rates are reduced in the developed economies, FII flows would be we'd be getting better FII flows. So a lot of these factors, multi-year growth visibility, you need to be present in the market to take advantage of that. As an investor, you must recognize that equity returns are non-linear, so there will be times of volatility, but there are certain days in the market which are the best days of the market, when the chunk of returns come in the market. So if you are invested for a longer time period, you are present during that time, you should not be concerned about any near-term, short-term fluctuations.
Right, right, right. And we have one question coming from Chandigarh from Rahul, who is an ideal investor as per you for Access S&P BSE Sensex Index Fund?
So I look at it, it's one of the simplest products through which you can participate in the Indian equity markets. So we are talking about participation in the largest companies, right? So it's the simplest product. So if you are a first-time equity investor, so it's a simple product, easy to understand. You can go for it. If you are an existing equity investor who wants to add an exposure, the broader things, for any kind of investor here would be to see that how it fits in terms of your existing asset allocation. What is your investment objective, whether you're willing to hold it for the long term, and whether you are okay with any kind of market volatility, right? So, and given the other segments in the market, in equities, this is the segment where the volatility is least. So you want to participate, but you're not okay with the kind of volatility you have in mid and small caps. So you have to see according to your risk appetite, according to your holding period, whether it fits into your portfolio in terms of asset allocation. How does it fit?
All right. And I think next question might be like one of the most asked questions throughout the chat. Like, can you tell more about like can we invest in the fund through SIP, or can you tell more about it?
Yeah, definitely. So in the scheme, you can invest in a disciplined manner if you are very much, if you don't want to time the markets, if you are, do not have a surplus amount currently to invest lump sum. So you can go for a SIP. So it's a disciplined investment which helps you reap the power of compounding, which helps you with rupee cost averaging. We have daily, weekly, monthly SIP, annual SIP, which you can do in the scheme, and the minimum amount for monthly SIP, and it for very little amount. For monthly SIP, for example, in this scheme you can invest with as little as 100 rupees. So definitely it's a very good means by which you can invest in this scheme.
All right, all right. And that might be the last question for today. That is passive investment a substitute to active fund?
See, it's not one versus the other. We cannot say active versus passive. It has to be a combination of both. So both of them have very different objectives. An active scheme is for an investor who wants kind of alpha generation, whose expectation is to have an outperformance over the market. So you should be okay with that, with the additional kind of risk that you are taking, right? So that is the active piece. While in a passive, you're looking for a low cost strategy where you know that your returns will be in line with the market, but you are okay with that, and as long as the returns are in line with the market, it's a low cost strategy. So depending on your preference, both of them can be a part of your portfolio. You can decide on the proportion based on your preferences. However, it's not that one over the other, so it has to be a combination of both.
Indeed, definitely. And that would be it for today's webinar. Thank you, Bablin, for your wonderful time. That was indeed a information-rich PPT, I would say. And that's it, guys, for the today. Signing off, Saurabh Pandey and Bablin Kaur. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.